Robert C. Miner is a name that stands out among serious traders. He's not a passing guru, he is a veteran with decades of trading, research, and teaching experience. His book, High Probability Trading Strategies, is a practical guide for building a structured approach to the markets. Miner's aim isn't to promise guaranteed wins, but to give traders the tools to spot setups where the odds are in their favor. The trading world is full of noise, endless indicators, systems, and conflicting advice that lead to analysis paralysis. Miner's work cuts through this clutter with a clear step-by-step methodology. He integrates multiple dimensions of market analysis into one cohesive strategy, teaching you to see the market from several perspectives. This approach is especially valuable for experienced traders who know there's no holy grail, just consistency and a solid plan. Miner builds on concepts like Elliott wave, Fibonacci retracements, and momentum oscillators, but he shows how to combine them into a powerful decision-making framework. The result? A logical structure that filters out low-quality trades and focuses only on those with the highest potential. It's not just about knowing what a Fibonacci extension is, it's about knowing when and how to use it alongside time cycles and momentum divergence. Miner bridges the gap between knowledge and application, emphasizing that a successful trader is a strategist with a plan for every trade. Risk, management, and discipline are at the core of his philosophy. This summary will break down Miner's core methodology, giving experienced traders a roadmap to refine their edge and achieve greater consistency. If you're ready to move beyond random chance and build a professional trading career, Miner's approach is your blueprint. He doesn't offer a shortcut, he offers a system. The focus is on process, not prediction. You'll learn to make informed decisions, not emotional guesses. Miner's strategies are about stacking probabilities, not chasing certainty. The book is a masterclass in putting it all together. Let's dive into the core components of Miner's high probability trading strategy. Here's how you can elevate your trading to a professional level. At the heart of Miner's work is a simple philosophy. The market is multidimensional. You can't understand it by looking at price alone. Miner's edge comes from analyzing the market from multiple, non-correlated perspectives. The highest probability trades happen when several key factors align at once. Think of it like a detective on clue is interesting, but several clues pointing to the same answer are compelling. Miner's method requires confluence across different analytical dimensions before risking capital. Unlike systems that rely on a single indicator, Miner's approach is robust and filters out false signals. The four pillars: price, pattern, time, and momentum. When all four align, you have a high probability opportunity. This multidimensional confirmation is the secret to avoiding overtrading and costly mistakes. It forces patience and discipline, waiting for the A+ setups. Miner's philosophy is about trading what you see, not what you hope. Your job isn't to predict the future, but to identify when the odds are stacked in your favor. By integrating these four components, you move from gambling to running a trading business. Every decision is based on a convergence of evidence. This shift in mindset is crucial for any serious trader. Miner's approach turns trading into a logical, repeatable process. It's about making strategic decisions, not emotional ones. That's the foundation of high probability trading. Price is the foundation of any chart. It's the market's final verdict. Miner's price analysis goes beyond simple support and resistance. He uses Fibonacci retracements and extensions to pinpoint precise reversal zones and targets. These levels aren't random. They're based on mathematical relationships in market moves. Identify key swing, highs and lows, then project future reaction zones. For example, A pullback to the 50% or 61.8% retracement after a rally is a classic setup. Fibonacci extensions help set logical profit targets in trends. The real power comes from price confluence when multiple Fibonacci levels overlap, creating a high probability zone. These clusters are where the market is most likely to react. Mastering this lets you anticipate, not chase, the market. Set alerts at these levels and wait for the market to come to you. This proactive approach reduces stress and emotional trading. Understanding price through Fibonacci is the first step in miner's strategy. Price tells you where a market might turn. Pattern tells you what the market is doing. Miner draws from Elliott wave theory but simplifies it for practical use. Focus on the most reliable patterns: 5-wave impulses, trend, and 3-wave corrections, counter trend. Spotting whether the market is trending or correcting is key. A 5-wave move signals trend strength. A 3-wave ABC correction signals a pause. The end of a C wave after a correction is a high probability entry to rejoin the trend. You don't need to label every squiggle, just recognize the structure. The main goal is to identify the end of corrections, where uncertainty is highest. When a correction ends at a Fibonacci support zone, you have price and pattern aligning. This dramatically increases your odds of success. Professionals see corrections as opportunities, not reasons to panic. Pattern recognition gives you a psychological edge and a clear plan. It's the second pillar of miner's high probability approach. Time is the most overlooked dimension in trading. Miner believes markets move in rhythmic cycles. Timing matters as much as price. He uses time cycles and time projections to anticipate when moves will end or reverse. Measure the duration between major highs and lows to spot market rhythms. If a market bottoms every 20 days, expect the next low in that window. Time projections use the length of previous swings to forecast the next turn. When price and time targets align, you have a powerful setup. Wait for both to converge before acting. If price hits support but the time window isn't right, stay patient. When both align, prepare for action. This systematic timing removes guesswork and adds objectivity. Momentum is the final pillar. It confirms if the market has the strength to move. Miner uses momentum oscillators, but not just for overbought, oversold signals. He focuses on momentum divergence when price makes a new high or low, but momentum doesn't. Bullish divergence, price low, momentum higher low, signals sellers are losing steam. Bearish divergence, price high, momentum lower high, signals buyers are exhausted. The best setups occur when momentum divergence aligns with price, pattern, and time. Miner waits for a momentum reversal when the indicator turns and crosses a key level to trigger entry. This prevents premature entries and confirms the turn. Only risk capital when all 4 dimensions align. Momentum is the engine. Wait for it to point in your direction. This discipline ensures you only take the highest probability trades. It's the final confirmation before you act. Having the 4 pillars is one thing. Applying them systematically is another. Miner's 4-step process turns theory into action. Step 1. Identify trend and pattern on 2 time frames for context. Step 2. Mark key price support, resistance zones using Fibonacci. Step 3. Use time analysis to find high probability reversal windows. Step 4. Wait for a momentum signal divergence and reversal to confirm entry. Only trade when all 4 steps align. This process removes emotion and impulse. It forces patience and discipline. Every trade is backed by a confluence of evidence. Follow this blueprint for consistent, high-probability setups. No strategy works without risk management and discipline. Minor stresses. Protect your capital first. Never risk more than 1-2% of your account on a single trade. This keeps you in the game through losing streaks. Place stop losses at logical levels just beyond the price structure that invalidates your setup. Discipline means following your plan, not your emotions. Wait for all 4 components to align before entering. Take profits at preset targets. Don't get greedy. Accept losses when your stop is hit. Don't move it. Your plan is your boss. Follow it without exception. Mechanical execution, free from emotion, is the key to long-term success. This is what separates professionals from gamblers. Miner's book isn't about secret indicators. It's about refining what you know. The biggest takeaway: use a multi-dimensional checklist, price pattern, time, momentum. Don't trade unless at least 3 dimensions align. Follow the 4-step process for every trade. Print it out, keep it on your desk, and use it to remove emotion from decisions. Add time analysis to your toolkit. Most traders overlook it. Measure and project time cycles for better precision. This extra dimension can take your trading from good to great. Miner strategies create a sustainable, professional trading business. It's not about getting rich quick, it's about consistent, low-risk, high-reward opportunities. For experienced traders, Miner offers a path to mastery. Discipline, patience, and structure are the keys. Adopt this approach to reduce stress, improve consistency, and trade like a pro.